Pick any newspaper headline from October 2008. Worst market crash since the Depression. Trillions wiped out. Investors flee stocks. What none of those headlines tell you, on the same days those stories were printed, one asset had its best month in decades. Another wasn't reacting to the crash, and a third was protected by something simple. People don't stop getting sick. The crash wasn't happening to everyone. It was happening to people who owned the wrong 5 things. In this video, Josh builds a portfolio out of the right 5. I'll show you the pattern first. 3 crashes, 3 different decades, the same 5 categories winning every time. Then Josh runs every candidate fund through 3 filters: cost, track record, size. The 5 that survive become the portfolio. And in the end, I'll show you how this portfolio, on just $10 a day, is projected to grow into $592,627 and pay $1,329 a month in dividends. But before any of those numbers exist, Josh has to actually find the 5, and the only way to find them is to figure out what worked the last time everything fell apart. So Josh pulls up 3 crashes, 3 different decades, 3 different reasons the market fell apart, and every single time, money behaved the same way. It left stocks and it went somewhere specific. The first one's the dot-com crash. Internet companies were trading at insane valuations. Basically, what investors pay for a company relative to what it actually earns, and most of these companies weren't making any money at all. When the bubble popped, the S&P 500 fell roughly 49% over 3 years. The Nasdaq, where most of the dot-coms lived, fell 78%. This wasn't a sudden shock. It was a slow bleed, March 2000 to October 2002. And then 9/11 hit right in the middle of it. The selling got worse. Money started looking for somewhere safer to go. Look at where it went. Long-term treasuries. That's basically a 20-year loan to the US government. We're up over 40% cumulative across those 3 years. Gold returned 24% in 2002 alone. And consumer staples, the companies that sell soap, toothpaste, soft drinks, gained over 11% a year while the S&P fell 22%. Now jump forward 8 years. Different crash, different decade. The housing market collapses. Subprime mortgages, home loans given to people who couldn't really afford them, turned out to be the foundation of the entire banking system. And it cracked. The S&P 500 fell almost 37% in 1 year. The biggest banks fell 80% or more. The financial system nearly broke. And the same pattern showed up. Long-term treasuries returned almost 34% that year. Gold went up over 5%, while everything else bled. Consumer staples lost just 14%, less than half what the broader market lost. Healthcare held up better than the index too. Different needle, same asset behavior. Then COVID hit. The economy shut down overnight. The S&P 500 fell 34% in 5 weeks, the fastest crash in modern history. Most crashes take months. This one took weeks. And again, the same playbook. Long-term treasuries returned over 18% for the year. Gold returned almost 25%, its biggest move of the 3 crashes. Healthcare rallied to over 18% as money flooded into vaccine and treatment companies. And consumer staples finished 2020 up over 10%. That's 3 different crashes, 3 different reasons, 3 different decades. The same categories of assets showed up every single time as the ones that survived or went up. That's what Josh sees when he overlays the data. Those 5 categories are what Josh builds the portfolio around. Here's what they are. The first category is quality dividend equity. These are companies big enough and profitable enough to pay their shareholders cash every year, even in a recession, even when nobody else is making money. Here's why that matters in a crash. A dividend is cash a company pays directly to its shareholders, usually 4 times a year. To pay one, the company has to actually be profitable. So when growth stocks are getting sold off, money rotates into these names, because the dividend acts like a floor under the stock price. 3 or 4% a year, just to hold the stock through a bad market. That's what makes these companies sticky. The second one's even simpler. Think about what people don't stop spending money on, even in a recession. Healthcare. People don't stop getting sick when the economy tanks. They don't stop taking their medications. Hospitals don't shut down. Insurance companies keep collecting premiums. Revenue stays stable. Earnings stay stable. Stock prices follow. The third one runs on the same logic. Consumer staples are the companies that make the stuff people buy no matter what. Soap, toothpaste, groceries, Coca-Cola, cleaning products. You're in a recession? You still need toilet paper. Your job's on the line? You're still washing your hair. Staples are recession-proof by design because the products aren't optional. Now the fourth one breaks every rule the first three followed. It's gold. It doesn't pay dividends, it doesn't grow earnings, it doesn't sell anything, it just sits there. But gold has been money for 5,000 years. When investors lose confidence in currencies, through inflation, money printing, economic instability, they buy gold to protect what they have. The only thing it does is move opposite the dollar, and the dollar always weakens during a crash. And the last one is the most consistent crash hedge in modern markets: long-term treasuries. Basically a loan you make to the US government in exchange for interest, where the loan runs for 20 years or more. Here's why that matters. The longer the loan, the bigger the price moves when interest rates change, and rates almost always fall during a crash because central banks cut them to stimulate the economy. When rates fall, long-term treasuries explode upward. The bigger the panic, the bigger the move. Now the question is which specific funds Josh picks for each one, because the wrong fund inside the right category still loses. There are dozens of funds in each of those 5 categories. Josh runs every candidate through 3 filters before it makes the portfolio. The first filter is cost, specifically the expense ratio. That's what the fund charges every year just to hold your money. A 0.25% expense ratio is $2.50 a year on every $1,000 you have invested. Sounds tiny. Over 30 years, the difference between 0.25% and 1% is tens of thousands of dollars. Anything above 0.5% gets cut. The second filter is track record. The fund needs at least 10 years of historical data, ideally enough to have lived through the 2008 crash. If a fund hasn't lived through a real crash, it hasn't proven anything yet. The third filter is liquidity and size. Liquidity means how easily you can buy and sell shares. Smaller, thin ETFs get hit harder during panic selling because there aren't enough buyers on the other side. Josh wants funds with billions in assets and millions of shares trading every day. After all 3 filters, dozens of candidate funds get cut. The 5 that survive are the ones in this portfolio. Next, I will show you what funds Josh adds to his portfolio, and by the end, I'll show you how this portfolio, on just $10 a day, is projected to grow into $592,627 and pay $1,329 a month in dividends. So here are the 5. The first name is SCHD, the Schwab US Dividend Equity ETF. It holds 105 large US companies that pay reliable dividends, names you'd recognize: Coca-Cola, P&G, Texas Instruments, Verizon. To make it into the fund, a company has to be profitable, have a strong balance sheet, and have at least 10 years of consistent dividend payments. SCHD is the foundation of this portfolio. 40% of every dollar Josh invests goes here. The yield is 3.35%, the second highest in the portfolio. The dividend has grown 10.43% a year for the last decade, and the share price has appreciated 8.95% annually on top of that. SCHD didn't exist for the 2000 or 2008 crashes, but in 2020, when the market had its fastest crash in history, SCHD finished the year up 15%, close to the broader market, with all the safety of a quality dividend screen underneath. Second pick for Josh is in the healthcare sector. People don't stop getting sick when the economy tanks. They don't stop taking their medications. Hospitals don't shut down. Insurance companies keep collecting premiums. That's the thesis behind VHT, the Vanguard Healthcare Index Fund. About 411 companies across the entire healthcare sector. Pharma giants like Pfizer and Eli Lilly. Insurance majors like United Health. Medical device makers, biotech, hospitals. Every name that shows up in healthcare news cycles ends up in this fund somewhere. 30% of the portfolio sits here, second largest position. The yield is lower than SCHD at 1.73%, but the work this fund does isn't about income, it's about defensive growth. Share prices appreciate at 7.87% a year, and the dividend grows at 8.83% annually on top of that. The proof showed up in both cases that VHT lived through. In 2008, when the S&P lost 37%, VHT lost only about 23%. Recession-proof revenue cushioned the fall. Then in 2020, VHT did something most equities didn't. It actually went up 18% while the broader market was bleeding through the fastest crash in history. Money flowed into pandemic response. Healthcare was the response. Third pick is XLP, the Consumer Staples Select Sector SPDR ETF. Holds the companies that make products people buy every week regardless of the economy. Procter & Gamble, Coca-Cola, Pepsi, Costco, Walmart, Philip Morris, Colgate, Kraft Heinz. XLP has a 10% position in this portfolio. The yield is 2.59%. Dividend growth is about 5.7% annually, and the price appreciates 4.69% a year. Smaller numbers, but a different job. Crash performance is where XLP earns its spot. In 2008, XLP lost just 15%, less than half what the broader market lost. In 2020, when stocks crashed faster than at any point in history, XLP finished the star up over 10%. And during the dot-com crash, while the S&P bled 22% annually for 3 straight years, the consumer staples sector returned 11% annually. 3 crashes, XLP held up through all of them. Now the fourth pick is in the gold category. Josh has picked IAU, the iShares Gold Trust. It holds physical gold bars in vaults. When you buy a share, you own a fractional slice of real gold. 10% of the portfolio sits here. The only number that matters is appreciation. And historically, gold has averaged over 11.17% a year in price growth. Why does Josh include it? Because gold goes up when the dollar weakens, and the dollar always weakens during a crash. Look at what gold did in each one. In 2008, gold returned over 5% while the S&P lost 37%. In 2020, while stocks were crashing at record speed, gold returned 25%. And in 2002, deep inside the dot-com collapse, gold gained 24% in a single year while the Nasdaq kept falling. Gold isn't there to grow Josh's wealth, it's there to protect it. And the last pick is the hardest one to defend on paper. It's TLT, the iShares 20-plus year Treasury bond ETF. It holds long-duration loans to the US government with 20-plus year maturities. Here's the problem. The annual share price return on TLT over the last decade is negative 4.15%. Every other fund Josh picked made money. This one lost money. Josh keeps it in anyway. The negative return came from a single year. In 2022, when the Federal Reserve raised interest rates at the fastest pace in 40 years, TLT fell more than 35%. That year drags the entire decade into the red. But during actual crashes, TLT is the most explosive hedge in modern markets. In 2008, TLT returned almost 34%, a 70-point swing in a single year. In 2020, TLT returned over 16.56%, where the S&P was crashing 34% in 5 weeks. And while you wait for the next crash, TLT pays you 4.55% a year, the highest yield in the portfolio with a dividend growth of 2.3% over the last decade. TLT loses when stocks win. TLT wins when stocks lose. That's the entire reason it's in the portfolio. Now it's time to see what they do together. 40% SCHD, 30% VHT, 10% XLP, 10% IAU, 10% TLT. 80% in equities, but defensive equities, not growth ones. 20% in pure crash hedges. When you blend the 5 together, the portfolio yields 2.57% in dividends, grows those dividends at 7.62% a year, and appreciates at 7.11% annually on top of that. And that combination is what compounds into the destination number. Now let's look at what the projection actually shows if Josh commits $10 a day to this portfolio. By the end of year 1, the account would hold exactly what Josh put in, $3,650. No real dividend income yet, the money just got in. 10 years in, the account would be sitting at $57,524. The dividends would be generating $1,321 a year. Year 20, $205,514. Dividend income that year, projected at $5,203, roughly $433 a month. Most of what Josh has at this point isn't his contributions, it's the market multiplying everything he put in over the previous 2 decades. And by year 30, Josh's portfolio would be sitting at $592,627. The dividend income alone is $15,949 a year, $1,329 every single month, paid out for the rest of his life. Now this portfolio's job was protection. If you want one built to outrun the market instead, 3 tech ETFs that all beat QQQ With one projected past $8 million on 10 grand, that video's on screen right now. I'll see you there.